Me personally, in my life, there are so many things that I do on a day-to-day basis that I do in systems. Whether it be running this YouTube channel, training Brazilian Jiu-Jitsu, my schoolwork, or anything else that I need to put my time and effort into. I believe that it's only right to take that similar approach to investing, and that's what I've been doing over the last 1.5 years as I've really changed as an investor. So today, I'm going to be sharing how to systematically build the perfect dividend portfolio for the long-term investor. Now, everybody's situation is different. I preach it on this channel. You may be older than me, you may be younger than me, but you need to systematically build your portfolio and investing strategy around your needs. Some people may be investing for dividend growth, some people may be investing for dividend income. It's really situation to situation. So there is no perfect one-size-fits-all here. Well, of course, except just investing in the S&P 500 or VU, but that's besides the point. So today, I'm going to share how to systematically build the perfect dividend portfolio for every investor. And with all the money you're going to be getting from your perfect dividend portfolio, there's no reason you shouldn't check out the Do Dividend Stocks Not Drugs merchandise. The link's in the description. Thank you, and of course, on to the video.
Hello, I like money.
Once again, I cannot stress enough. This entire video is based around your situation, so you've got to be honest to yourself here. Do you need the dividend income in less than 10 years? Or plan to use some of it in less than 10 years? Me personally, I'm hoping to use some of my dividends, definitely not all of them, but I plan to use some of them to do some fun stuff. Vacations, cocaine, and other recreational activities. But in all seriousness, if you do not need the dividend income less than 10 years, you have a job, another source of income, you don't plan to use it in less than 10 years, go for dividend growth. But hey, maybe you're 25, you want to retire by 40, 50 years old, you want to have the dividend income in 10, 20 years, have a mix of dividend yield and dividend growth. Not all dividend yield are bad companies, and you're not going to sacrifice total return. Look at a company like Pepsi or AbbVie. They still consistently have a high dividend yield, 3-4% relatively, and they offer solid growth and free cash flow growth and total return, stuff that also matters to maximize building your wealth through stocks. But if you're really investing for the long term, you're like 10 years old or something wild, you're investing for 30, 40, 50 years of compounding, like I probably am, obviously I think it's the better way to go with growth. But when you see an amazing business trading at an undervalued price, and it's amazing business, it has to be a really good business, we're going to get to that of course, I think it's fine to invest in a company with a higher dividend yield. I think that's something that's been kind of scrutinized a lot recently, is that investing in a company that has an over 5% yield, it's automatically an underperformer. The S&P 500 is the better way to go. I think that's so foolish, especially when it's an undervalued business. Some companies just naturally trade at a low valuation and have a high dividend yield. It's your job as the investor to realize what the asset is worth. And obviously, if you need the dividend income now, you're in a bit of a stretched situation, you could say. I think it's obviously probably better to go with some higher dividend yield stuff, but of course, make sure that it's actually quality. Make sure it's not a yield trap or some yield max fund where it's very unreliable month to month. But how do you find quality businesses and quality stocks? That's the next part of this. These are some of the quantitative things that I look for. This is what you look for when you look at a company's financials. Go over on dividenddata.com, use my link, wink, wink. To start off, I put it in all caps and I put an extra W at the end of it just so you guys emphasize it here. Free cash flow. Free cash flow will be the origin of any dividend payments you want to get in the future. If there's no free cash flow, there's no dividend. Dividends are the result of a company's free cash flow. And once again, there are going to be quarters to quarters where a company has negative free cash flow. But it's your job as the investor to realize whether this is temporary or a long-term issue. An example is Target. Target recently had an issue that I believe was a short to medium term issue, and their free cash flow went in the red for a year. But as an investor, I realized that this was not a long-term issue as long as their execution went through, and it's recovered since then. And once again, the more mature a company is, the more likely it is that you're not going to be seeing robust free cash flow growth. As long as it's consistent and it's trending upward over time, it's really situation to situation. Obviously, Coca-Cola, a more mature company that's been around for like 300 years now, it seems, is going to have slower free cash flow growth than a company like Visa that has robust growth ahead of it. That's just how it works as an investor. You want to see dividend growth that's above inflation, because essentially it's pretty much a pay cut whenever you have a dividend hike that's below inflation. Now, sometimes companies, it can be really weird, year to year. Sometimes they'll have a year where they hike the dividend 1%. Ideally, you want to see some consistency when it comes to dividend payments and hikes. Now, there obviously are some companies that are in different situations, so you need to do your due diligence here. An example of this is S&P Global. They've been making new investments and acquiring companies like crazy recently, and they're putting their free cash flow towards that and growing their business. So it makes sense that they wouldn't be hiking their dividend 15% in that same year, where they're putting that dividend hike money they could potentially be doing into a different investment for their business. So you got to do your due diligence here. Also, I just think it's really stupid to be expecting 15% dividend hikes for about 50, 60, 70 years. That's just unsustainable. For me personally, I like to look between 6 and 12%, and that's going to be averaged out over a 10, 20, 30-year time horizon. That's where the compounding happens. But Ryan, I got an 18% Visa dividend hike this year. Obviously, yes, there are some companies that are going to be continuously growing their free cash flow like wild. Those are the businesses that you want to be in. But it's just not sustainable for 50, 60, 70 years if you're on a really long-term time horizon. But you want to make sure that the dividend growth is above inflation. Once again, the more mature companies are not going to be hiking their dividend 18% every year. Dividend yield on cost will eventually kick in as well, and that's a really nice perk for the long-term investor. Another thing you want to see is a payout ratio below 70% of the free cash flow. Now listen here, I understand 70% for a lot of you guys, that's really, a lot of people are kind of scared at that. But it really depends with some companies. Some companies historically, obviously the more mature ones, the bigger ones, the ones that have been around for a long time that may have a higher dividend yield, they're obviously going to have a higher payout ratio. Preferably, I like 50% or below. I think that kind of offers that happy medium there. Most of the companies I buy these days are way below 50% anyway. And make sure that the free cash flow is the payout ratio and it's not based off of the net income. For accounting reasons, you want to look at the free cash flow and that's actually based off of their business and the cash flow that's producing. Big thing there. Also, buybacks are something else you want to see over a long-term time horizon. Once again, situation to situation. Something you really do want to see, though, with businesses, if they're on a big decline and qualitatively their business is still fine, the fundamentals are in line and stuff, you want to see companies that are buying back shares. An example of this is Altria, stock ticker MO. Fundamentally, they're fine right now, but the market doesn't seem to love tobacco companies due to higher interest rates and the fact that they had some issues when it comes to their vaping segment. But fundamentally, their business is fine and the cash flows are still coming in. They're buying back a lot of shares at these low prices, and that creates a lot of shareholder value over a long-term time horizon. ROCE is return on capital employed. This is basically another financial metric to really determine how efficiently a company can reinvest the money back in their business. You want to see a high ROCE. And also, you want to make sure that revenue equates to free cash flow. Revenue is probably the most overrated metric when you're looking at a company's financials. Revenue means nothing if it does not equate to free cash flow. And finally, the last question. To or to not reinvest your dividends. Now, me personally, I'm a huge fan of reinvesting your dividends, especially when you own a lot of great businesses. It's an amazing way to naturally build up your stake in a stock without having to buy any more. Also, you can't time the top or the bottom. There are some companies that I reinvested dividends at that I actually got my cost per share down. You can't accurately time the top and bottom of stocks, and reinvesting dividends is an amazing way to build up your position in a great business. But I also understand the people that do need the dividend income. But I believe if you could hold off and reinvest your dividends on a long-term time horizon, you could see the insane compounding effect that it has. I can only imagine in 35 years what my dividends reinvested could potentially look like, reinvesting a complete salary back into my dividend portfolio. That's what gets me up in the morning and gets me fired up about dividend growth investing. But obviously, I think dividend growth investing these days is just another translation for buying great businesses and holding, and buying more when they go down. That's honestly all you need to remember from this video if you want to take away one thing. Buy amazing businesses that will be around for the next 100 years, hold them, and buy more when they go down. That's all you gotta do. But once again, I understand it does take a long time for the compound to really show, probably actually 20 years. So if you can't wait that long, you're a bit older, it's probably a better idea to take some of the dividends out, reinvest, pick your spots. I understand if you want to buy the penthouse, you want to buy the nice car, life is not guaranteed. Time is not guaranteed in the future. I think it's fine to take out some dividends, contrary to popular belief. I think it's fine sometimes to take out some dividends for some experiences, but you just got to be smart about it. Another reason a lot of people invest is to provide for their future families and people they're going to be around. So that's another thing you got to keep in mind is, do you want that nice car, or do you want little Johnny to go to college? I want to thank you guys for making it to the end video. This is a fun one to make. If you guys like this kind of content, let me know in the comment section. Also, smash the like button, subscribe, check out the Do Dividend Stocks Not Drugs merchandise if you haven't already, and the Cash Flow Kings live show every Saturday, 8 p.m. Eastern. Thank you guys for watching. Do Dividend Stocks Not Drugs, and have a good one.